Welcome everyone to another episode of Mere Finance. Rate cut 2024 fiction. Last year, we even heard that the market was pricing cuts and cuts and cuts, and we went from 2% to 5%, 5.5 in a matter of months. And now we're saying that we're going to get like 7 rate cuts. So I think that's fiction. Now it's down to 4, but I think we won't see anything. And why? Because there is the nominal GDP is going at 6 to 8% growth annually. Like every quarter, we're seeing strong numbers. We're seeing elevated economic activity. We see productivity going up as well. I don't think it's because of the artificial intelligence, but because of technology is increasing, and because we are seeing that energy prices are being stabilized, which spills into the rest of the economy, and we see more and more growth. And also, inflation is running hot still. Last week, we saw a 3.1%. But if you check in the automotive and the groceries list, it's around 20%. Automotive, we refer to insurance, maintenance, new cars, groceries. If you go to the grocery stores, at least 20%. Like, there is no way. I went to Costco the other day, $80, the same stuff 1 year ago. Now it's $130, and I bought the same stuff because I have my receipt. So it's fake that it's at 3.1%. It's way higher, so it's still running hot. And also the labor market is stable. Remember, the Fed has 2 main mandates: price stability and employment stability. So you already have employment stability. There's no need to change anything. Now they need to bring down still inflation. And for that, if they cut rates, they're going to accelerate that inflation. And this is the one that worries the most. This is the Supercore inflation, which is a measure of sticky inflation. And you see that all the way in 2020 was actually negative 2%. And it got, by the end of 2023, seemed like the Fed had a handle on Supercore inflation. You see all the way up from 8% to almost 22.3%. And now it's up. It's almost to 5.6%. And it seems to start getting higher and higher. So 5.5 actually is currently sitting at, and you see 4.5 at the end of December. So this is what worries everyone the most, and I think this is why we won't see any rate cuts. And along with this is by one of our authors. Is a graph that we are utilizing. Is the U.S. inflation and money supply change from Bastion Manager, and we see the big correlation that it has. But money supply is always a leading indicator. You can see when money supply start dropping, then a few months after, inflation start also descending. And money supply has been going up lately since September until now. Or it's projected to go up since now until September. So we see that inflation in a 14-month lag might raise again. So there's a huge risk that we'll go back into that terrible inflation robin. And then this is what we did. As of June 12th, as last week, we had this, to the right, we have the numbers of last week and how many rate cuts do you have. So in the bottom, 7.8 was no rate cuts, 41.9, 1 rate cut, 43.5, 2 rate cuts, 6.8, 3 rate cuts. And now to the left is what we have this week. So we went from 7.8% to 18.4% in no rate cuts based on the Fed futures. We also saw an increase from 41% to 53.7% of 1 rate cut. And the most important one is that we dropped from 43.5% of 2 rate cuts to 25.75. So 2 plus more rate cuts, it's only 27.9%, when last week it was 50.3%. And I think Mere Finance has been good in saying that there is we saw last year that we're not going to see any rate cuts. We're seeing something is going to break, but it hasn't broken. And when inflation is keep going up, and rates are going to produce more damage. And this is the target probability for June 2024. You can see now vary between the current rate, which is the 5.0% to 5.50, we have around the 50% probability. So it doesn't seem that we're going to have a rate cut. And I'm pretty sure next week, as we rerun this graph again, most of the probability will go into the 525 bips to the 550 bips. So that's our story. What do we think is going to happen? I think inflation will come back. As inflation will come back, rates will remain high, and then it's good to be again in your fixed income, especially in those floating rates. When you get 300 bips from the SOFR rate, you can really get that coupon coming in, or your long-dated fixed income securities like CDs or treasuries. I just keep compounding and rolling over, because I don't think rates are going to go down. So thank you for watching, and let us know what you think.